Topic of conversation, big surprise, tariffs. What's going on, market reaction, and just kind of what to make of it as we move a few weeks into this whole scenario. Let's get into it this week. Here we go. Hey everybody, welcome into the podcast. Thanks for hanging out with Matt and Steve and myself as we talk investing, finance, retirement, and tariffs is on the conversation, guys. Big surprise here on Retirement Approved. So how you guys doing this week, Steve? What's going on, buddy?
Hey, I'm hanging it in there. I'm taking it a day at a time right now.
A day at a time or an hour at a time?
Yeah. I guess an hour at a time today, right?
Yeah,
so we had
exactly.
Bessent talk this morning, and now we have the president talking at 5. So we'll see how the day plays out.
Exactly. Matt, how are you, my friend?
I'm doing fantastic. Can't believe we're 3 weeks into this mess already, but hopefully we're showing signs of the market coming back, and we'll run through that all.
Well, let's get into it. I know you've got slides prepared for us, so we can't wait to see them. So let's get into it. Let's do a recap, I guess, right? Where we're at, proposed tariffs and stuff.
This is our first episode since Liberation Day on April 2nd. I don't know what we got liberated from besides our market gains, but we just wanted to lay out the month of April and just how I think the only word to describe it is chaotic it was.
Maybe chaos by design?
Could be.
Still remains to be seen.
Yeah, we don't know what the master plan is still. We're 3 weeks in. Is it purposely crashing the market? Is it negotiations? Is it bringing manufacturing back home? That kind of stuff. So we'll get into it.
Well, we were all surprised that we thought we were going to see the 10% reciprocal tariffs, and the market was reacting favorably to the president's Liberation Day speech, and then all of a sudden he hit us with that colorful board.
The reciprocal tariffs based off of trade deficits, which I have not heard any economic argument that makes any sense whatsoever. It'd be like the LA Lakers telling LeBron James, hey, play worse so we can pay you less. It just, I can't fathom a way that this makes sense other than it being a negotiation tactic, which right. I think ultimately it is.
Well, exactly. Create chaos by design here. And they knew how the market was going to react. And we actually had a conversation. We said, they're probably just going to do this for maybe a week or two. We didn't think it was going to be days, but a week or two before they do some sort of pause, just to give everyone a look at how much chaos this would cause. And then we had the fake news, the 90-day pause, and we go, this makes perfect sense. We actually talked about this, a couple of days ago, but then that turned out to be fake news. And the White House came out and said, nope, we are absolutely not doing that. That is fake news. To only 2 days later, do the 90-day pause.
Exactly. Yeah. Right. We logged into Twitter and saw, 90-day delay reported by Bloomberg, not some random news source out there, by Bloomberg, and market reacted favorably. And then immediately the White House said, no, we're not doing that. At which it's like, you never see the White House respond quick to anything like that. It's like, okay, well, I guess more pain. And that's where you see that dip into that 90-day delay. And then I think the market was up 10% across the board, S&P, NASDAQ, Dow. It was a fun day.
I can't tell you how many phone calls I had where we got the fake news and it's like, hey, don't sell here. Don't panic. We could get news within a day or two. Who knows what's going to happen? There could be a deal or some type of outline of a deal within the next week or two. And that could cause the market to just go on an absolute rip. And then 2 days later, after all of this panic and fear, we get the 90-day pause and some relief, and we see, if you look at the chart, how much the market went up in one day. We had one of the best days in the history of the market. So good luck. Good luck trying to time these tweets and time this market.
And that's exactly why I've been telling our clients when we're talking through this, just saying, hey, what we're doing, we're hitting the pause button. We're not making any dramatic shifts. We're not moving to cash. We're not buying the dip with significant portions of funds at this point, because we want to let this thing play out, which is after that 10% day, you can see there was China escalation. It's kind of China escalation throughout this whole thing. But then there was some backtracking on some of the stuff they said, and there was no deals announced, even they said they were making progress. Then ultimately they did a ban of NVIDIA chips to China, which at the end of the day, not a big deal there. And then it was Fire Powell. I think he called him a total loser.
Was it a complete and total loser?
total loser. And then the day after he comes out and says, no, I'm not firing Powell, which I think Bessent probably got in his ear, told him what to say there. And then Bessent ultimately talked and said, hey, we're going to hopefully de-escalate with China. He actually talked this morning, and the markets reacted very favorably so far.
Yeah, so we're recording the show on Wednesday, so I just want to put that out there.
Yes,
and the president has not spoke yet. That's at 5:00 coming up. But Bessent talked this morning, and he did talk about de-escalation and how the current tariffs are just absolutely not sustainable. And he did talk about decoupling and how they want no decoupling from China, and how they want rebalancing there. So they're going to work together. And then China came out about an hour before we recorded and said they're happy to open negotiations back up and get this on the right track. So
that's positive.
A lot of good news today. Yeah.
Yeah.
But by the time this airs on Friday, there will probably be more bullet points added to this slide here. But at the end of the day, if you look at where the market's at beginning of April, we're not down terribly. But keep in mind the market was up 10% earlier this year prior to April. So that's kind of what's magnifying these gains, or not these gains, these losses a little bit.
Right. Well, can I ask you guys a question to kind of just, in that layman aspect? So like if you pull up the S&P 500, if you Google it, and again, it's going to change, any second that we're talking, but if you hit the, the 6 month, it's down about 7%, the S&P. If you do year to date, it's about 8. If you do the 1 year mark, it's actually still up 6%. And if you hit 5 years, it's at 90%, right? So, I mean, sometimes I think we're so focused on the negative, and I get it, it's hard not to be, but it's still overall, it's not like as scary as it was in 2008, at least not now, right?
Right. And that's why I'll throw this chart up that just shows the terrible starts to the year. So this is the first 73 trading days, the worst starts to the year we've ever had. So you got to go all the way back to 1932 for the worst 73 days. That'd be almost 25% down. So this is the fifth worst start to a year that we've ever seen, down 10%. But you look at those first 4 years, I think I see one thing in common. The market recovered for that remaining year. So you can see it was green throughout the rest of the year. So 13% in 1932. And then we all remembered COVID 2020. The market rallied 34% to finish the year. So where are we going to go from here? Our hope is up, and that this tariff solution tariff mess gets resolved a little bit, but we shall see.
I was waiting to see what you're going to say. Where are we going to go from here?
Yeah.
Where are we going to go from here? There's
interesting that 2022 is on there as well at number 8, right? We forget that just a couple of years ago it was pretty rough for a while.
Yeah. Well, you look at the fear and uncertainty, what we just went through the last 3 weeks. I mean, I haven't seen that type of fear since 2008. 2020 COVID, it happened so fast. And we had the data. It's like, you know what? They're going to cut rates. We're going to see QE, stimulus packages. I think we pull out of this. We never thought we were going to pull out of it as quick as we did, but I think we pull out of it, by the end of the year. And it all happened so fast that most investors really couldn't make mistakes. But you go back to 2008, and again, I'm seeing the same type of fear now and just that uncertainty. Huge mistakes were made in 2008. I still sit with people coming in going, man, if I just didn't sell in 2008, my portfolio, I'd be in such a better position. It's, you got to make sure that you don't buy into that fear. And in 2008, we were talking about it. It's like I had clients who still have newspaper clippings from 2008, but now we've got social media, and you go on to Yahoo Finance, and there's just all this fear and all these headlines. So it's just amplified now.
Big time.
But the last thing you want to do is react, especially when we're just waiting on tweets. There's no data to analyze. You have people on the left saying the world's going to be on fire in a couple of months. You have people on the right saying, hey, negotiations are going great. We've talked to over 70 different countries, and they've all went well. So it's like, who do you want to believe? And do you really want to sell out right now and move to cash when we could have a 15% day, who knows, off of a tweet from the president later? So you just don't want to react. And I gave my dad a hard time for this. Back in 2008, I was a young advisor, and I sat with him on a meeting, and I remember him telling a client in 2008, just sit on your hands. Don't react. Don't do anything. Just sit on your hands. If anything, just continue to DCA into the market. And it was full blown panic at that point. I remember thinking, I mean, is that really even advice? Just don't do anything. Absolutely is. Now we're telling our clients the same thing right now. Trust the plan. Don't do anything. If you have some extra cash, buy these equities while they're beat up down 15, 20, 25%.
Yeah. And I was just sitting with a client this morning, and they had a larger value position, only down 2% at this point. They had a diversified 80-20 plan. So international equities included, only down 3% on the year. So the pain isn't so bad for diversified investors. And that's what we've made sure to do over the course of the last year, is make sure we're not overexposed to those magnificent 7 companies, which have been taking a beating this year. They were all down over 20 at one point, and I'm sure they'll be the first to recover. We're going into big tech earnings season coming up, so we'll surely see them move one way or another. But the one thing to keep in mind is, in down markets, the best days come after the worst days. And that's exactly what we saw last week with the 10% bump, or 10 days ago, whatever it was, that 10% bump in the markets. That was after the max pain days. And actually, I was shocked to see this chart, but 50% of the good days in the stock market happen in bear markets.
Wow.
Happen in bad markets. So that's why you're not looking to time the market, get in, get out, because if you miss the 10 best days in the market, that more than halves your investment return. And you can see that chart on the right, 1995 to 2024, last 30 years. If you invested $10,000 and missed the best 10 days, you're at 100,000 versus being fully invested. You'd be at more than double that.
Wow.
So good luck timing the market if you're getting in, getting out based off tweets.
Well,
this is just, I mean, it's now amplified. I mean, again, we're waiting on tweets. You just don't know what's going to happen on a day-to-day basis.
I should correct you. We're waiting on Truth Social.
Truth. Yep.
Which and then reposts on
and then
tweets.
retweets.
Yeah. And it all moves so fast too. When he posts, it gets fed to Twitter, and then the algo traders and bots pick it up. And even if you're sitting at your computer, good luck making a move before they do.
Well, then you have people going, fake news. This is fake news. It's like, is it fake news? Well, I've got to figure this out. But I mean,
Steve, I was going to ask you, because you said about, you thought your dad was maybe a little nuts, but as a senior advisor, seasoned advisor now, it makes a whole lot more sense to sit on your hands. Yeah.
It's kind of came full circle. And now I have some of the younger advisors shadowing me and sitting with me in meetings and going, is that really good advice? Like, that's excellent advice.
Is he telling you, is he giving you the I told you so?
Oh, I've gotten that a few times. Yeah.
Okay.
Yeah.
All right.
But the other question I'm getting from clients right now is, the market's crashing, chaos everywhere. You got wars, inflations, tariffs of 145%. Gold is surging. Gold. Headlines everywhere. I'm getting text messages. I don't know who signed me up for gold text messages, but it's everywhere and you can't get away from it. It's skyrocketing, 3,500, Wall Street Journal, CNN, Bloomberg. And a lot of clients are saying, should I get out of the market and into gold? And I know we did a podcast on this last year when gold was surging. We actually marked the top with that podcast, but we're not anti-gold by any means. We like to exercise caution with our clients and say, don't pile in, and don't pile in at the wrong times, because this chart actually shocked me. 1980, the 1980 top in gold, adjusted for inflation, just got broken. So if you bought gold all the way back in 1980, adjusted for inflation, you are now in the money. Congratulations.
45 years. Yeah.
Yep. And I know what people are going to say. You're cherry picking the top here. And I know I am, but that's how people buy gold. So what I did was I overlaid Google Trends. That's that blue line right there. So how many people are searching buy gold? And naturally, when more people are searching buy gold, more people are buying gold. And that lined up with the exact top in 2011. That's when most people were searching buy gold. That's when most people were getting into gold. And congratulations, now you're waiting on a decade to get back to even, not even adjusted for inflation at that point. So that is the definition of herd mentality right there. And that's why we're exercising caution on.
So if you have cash on the sideline, I mean, when you make a trade in a down market like this, you're not looking 3 months out or 6 months out. I mean, when you're making trades, you want to look 2, 3, 5 years out. And do you really want to go in and buy gold at an all-time high? Or do you want to buy some of these tech positions that have been beat up 20, 25, 30% at these major discounts during a tech revolution? I'd take that bet with anyone. I mean, I am in my own portfolio. I'm not buying gold right now. I'm buying these companies, beat it up. But I'd take that bet with anyone. 10 years out, the NASDAQ versus gold from here. You do like a screenshot of that and just we'll throw it up in 10 years and see how that plays out.
Yeah, I mean, gold's not going anywhere by any means, but I like to tell people the time to buy gold is before the chaos, not during the chaos, and that's kind of what you can see at this chart if you study it. Look at 2020, before 2020. Google searches for buy gold were pretty much at a low, and no one was buying it. But then that's when the run up occurred in 2019, 2020, and then now. And now is when people are going to be start piling into gold, and they could get hurt. You could get 10 years of sideways movement, 20 years of sideways movement. It could run to 4,000. I don't know. It's a speculative asset based on no fundamentals other than the printing of money, which is going up. So that's bullish for gold, but there's no PE ratios, there's no dividends, nothing to value.
Another thing that we have to look at too with gold is Bitcoin. I mean, gold is a store of value, and you talk to anyone 45 or younger. So if I talk to my friends that are doing well, that are successful, and I ask them, how much gold do you have in your portfolio? They're going to laugh at me. And well, how much Bitcoin do you own? Well, I own X amount. Well, what would you rather have going forward? Of course, Bitcoin. Why would I ever buy gold? So you look at those investors under the age of 45, they're buying Bitcoin for store value. The returns have been far superior. It's mostly boomers buying gold. So I do think going forward, Bitcoin does eat into gold's market share and brings demand down a little bit. But again, I still think there will always be that demand there for gold. I don't think it's going to come close to the market moving forward over the next 10 years, especially with where it's at right now.
Yeah. And I mean, just looking at gold versus the S&P 500, we won't throw Bitcoin in this chart because that would make everything pale in comparison.
But there you go.
Yeah, this is going back 40 years. This as far as our software would go back, but gold, a $10,000 investment would grow to 100,000. So you have 10 extra money, outpacing inflation slightly. And then the S&P is growing to 290,000. So that's kind of game, set, match, market versus gold. I think it's a pretty darn good argument. Now, you could say this is cherry pick data as well. You're ignoring the 1970s when gold ran. And it's like, you can only pick so many time periods. I think 40 years is pretty fair. And I think it will continue to outperform gold. The market will continue to outperform because, like you said, we have all this tech innovation. This is not a time I would want to be sidelined in the market with the AI revolution, biotech, so much more, and humanoid robots, space exploration. So I say stay invested, stay diversified though. That's rule number one of investing. Don't go all in on tech. Have some of the boring value. Own small caps. Small caps taking it on the chin. It's worse down than tech year to date. So that's something we're continuing to add to DCA in and not over allocate to gold by any means.
Okay. Well, and one more piece, I guess, of advice would be don't do anything unless you've talked to your advisor before, see how it's going to fit you. Don't just something you hear on our podcast or any other. Always make sure you see how it relates to your very specific situation. All this stuff is universal to all of us, but at the same time, everybody's situation is different. So as always, if you got some questions, need some help, please reach out to the guys. Get yourself some time on at the calendar, have a chat. rwpaul.com is the main website, rwpaul.com. We'll put links in the show descriptions below. Don't forget to subscribe to the podcast on Apple or Spotify or here on YouTube for Retirement Approved. We'll have links to the website for that as well. So all that good stuff involved. So we'll see you next time here on the show. Again, hit that subscribe button, click the links below. And thanks for breaking it down, guys. We'll see you next time here on Retirement Approved with Matt and Steve Paul.
Retirement Approved is brought to you by Richard W. Paul & Associates, an SEC-registered investment advisory firm. Throughout the presentation, we may generally discuss different financial vehicles. However, nothing we say should be construed as a recommendation to buy or sell any financial vehicle, nor should it be used to make decisions today about your investments or insurance. For full disclosures, check the show notes of today's episode.